means they're going to want another 5% down
for the down payment.
Yeah.
Well, let's talk about it.
Yeah.
That's how it works.
Well, if you don't have a tenant, typically they are instead of let's say the best it's only 15% down, that's 85% loan to value. So instead of 15%, if you don't have a tenant, they're going to say, well, we may want 20% now because you don't have a tenant. Therefore, it's good if you're a seasoned or somewhat seasoned investor that you have that lease in place. 1 month's rent, 1 month's deposit. But you can always call upon the local real estate company that keeps a bunch of persons active. Then there's no shortage of people looking for somewhere to stay. But at the end of the day, all banks want their money back. Whether it be a brick and mortar bank or some stock or some hedge fund, everybody wants their money back. And this is the most liberal of all. And still sometimes I have persons complaining about the rate or, well, I got to put so much down, because down payment is commensurate with credit score. So credit score is when you're saying unpack it, that's another principle. The higher your score, the less you put down and the more you can cash out if you do a refi. And using these products to keep your credit good, filing your taxes so that you can buy a house traditionally. But what we find in this industry, oftentimes people want it all. And you can't get it all. You're going to have to fit somebody's box. Somebody's rule.
If you want their money.
If you want their money. Now, if you don't want to file your taxes, you want to be self-employed, we have products for that, a bank statement and profit and loss. But then again, there's 15% down, 20% down. And people are screaming about that. Well, how can I get it for a regular down payment? File your taxes.
Today, we're talking about real estate investing financing using the DSCR loan. I've got a veteran in the podcast room with me today to break down exactly how these finance products work. And the good thing about it is you don't have to go out there and raise private money. They already have programs for you. So this loan is for investors that want to do long-term hold properties, but they don't quite qualify for traditional financing. Let's get into it. So I'm here with my brother, Renard Boyce. How you doing, sir?
I'm great. I'm happy to be here with you.
Good to see you. Good to see you. Yeah. Thank you for sacrificing your time.
Thank you for making time for me.
Well, that's cool. Yeah. So you've been in the game. Tell us a little bit about yourself and the background.
Well, been in the mortgage business since officially got my license in 1996.
Wow.
Started in 1992.
Working under somebody else's license.
Somebody else's license,
yep.
As a loan officer, then a VP. I had a net branch. Then I opened Temple Mortgage, 1996, with the help of the then Speaker of the House, the Honorable Thomas Moss, because the state made it very difficult for a brother like my pigmentation get a license.
Too much melanin.
Yeah, too much melanin. So I had to reach to the tip top of the state of Virginia, who helped me, and I still thank him for it. And and I can't say the rest has been history, but that's where it began. Had a radio broadcast simultaneously on WPCE entitled Banking with RS Boys. My first broadcast was entitled, If Your Grandmother Has a Mortgage, Then There's Something Wrong. Some guys came to me and said, my grandmother's suffering in this mortgage. And my first question, well, how old is your grandmother? And they were like, she's 75, 80. I say, well, your grandmama got a mortgage, dog. Something's wrong. Yeah. And so that's kind of where the broadcast took off from there. And it was, I guess I've always prompted or directed my services or my practice, for lack of a better term, to the Afro-American community or to people in desperate need of knowledge. The Bible says due to a lack of knowledge, our people perish. And that's especially true in financial services.
Okay.
We perish overwhelmingly more than others because of a lack of education and introduction and saturation of the material. A lot of times nobody tells us. And it starts from childhood on up to adulthood. Simple things like checking and the value of credit, which parlay and it spills over into adulthood. And sometimes people suffer for years because of decisions they made. So that's what we try to do, even some of that out, bring good knowledge.
Okay. So this DSCR thing, we're going to get deep into that.
Yes.
You've been around the game. So I just want if you could just unpack, people think this is new, the DSCR model.
Yes.
So just give us a little history, because you are the research.
Well, it's been out a long time, way before COVID. It was back then, we had different versions of it. You had back then the no-doc loan.
Talk about that.
The no-doc was no financial.
That's what I got in with.
Yeah.
Early 2000.
No financial documents, based even as today on credit, the strength of the credit, and the property being able to cover the mortgage. So that's where the debt service CR part comes in, the debt service.
Okay.
And then there were so many persons jumped into it. It was phenomenal how many people were doing the no doc investors. It kind of the Wall Street investor, that was a prelude to the Wall Street cats getting in the game. And because a lot of that,
what is it called? Mortgage-backed securities.
Mortgage-backed securities.
Oh, Lord.
Yeah, the hedge fund boys.
Lord.
Right, Silicon Valley, all those guys. So that's where a lot of the driving impulse came from. And they were flooding the streets with money. But it became a heyday for investors. But as in my opening remarks, we sometimes, being people of color, become the last to know. The further south, it seems like the less informed. But there were persons who were gaining exponentially in terms of gobbling up investment property using this product. Then comes COVID. It goes away. When it happened, I think I had like 20 loans that I could not close. I had some that had closed, but we couldn't fund. I mean, money tied up at the table, had some, and the companies went out of business. Now imagine that nightmare. I mean, I think I was subpoenaed to court about 5-6 times.
For what?
Just because the money was caught up, I had to go in there and tell the judge and explain, and everybody's fighting. I mean, I wasn't in trouble, but I had to tell the story to the court.
In the chain, though.
Yeah, I was in the chain. Right. So the judge, so it was a hodgepodge, to put it mildly. So then all that smooths out, and then it comes back smoother. Once again, dedicated toward the investor crowd. Persons want to buy property, and once again, all over the country, especially in high, what you may call investor-friendly states like Florida, a lot of investment, South Carolina, another place that people are sleeping on, Texas is popping, but it became available. And let me just stick this in. Let me disclaim this whole notion of racism. The beautiful thing I love about this program, it permeates racial limitations.
What you mean?
I have never, 90% of my clients are black. And as much as a lot of persons of color cry racism, and it may be, I don't ignore that there's racism in banking, but in this one, it's based on 2 factors, credit and money. You have the credit, you have the money. I can say this as an Afro-American company owner whose clientele is 90% Afro-American, probably 95. I haven't had anybody denied that had the credit score and the money. I've had people deny it because they pulled some foolishness. I've had some people deny it because their paperwork wasn't as they presented it to be, or maybe we had some title issues. But based on being approved, the approvals come back lickety split. Like sometime within 48 to 72 hours, people are approved. It's a game changer.
Okay, well, let's get into this today. Debt service coverage ratio. I don't, AKA no doc. So
no doc.
The reason I bring you in, Renard, is because I am a huge practitioner of not using traditional financing. Remember, I told you that.
Yes, sir.
I go right to the private sector.
That's right.
But I've learned, and the God has put on my heart when we met, and I'm like, you know what? Not everybody's going to go out in the streets and talk to people and get money out of people.
That's right.
They're just not going to do it. As much as I want to shake them and like, look, go ask for the money.
Right, right.
They would much rather go to a computer or a person that's in the money business like you and go that route. So that's just a given that I've learned.
Right.
So I would like to just be a proponent and an advocate to help more people with this. So you can explain it, because I don't know how to explain this thing.
Well, it helps people level up. Just like you said, you're going to the private money sector and building your financial empire and your portfolio. Persons can go within, when I say within, they can tap their own property and become self-funded. The beauty of this product versus the bank is the no doc part of it. We kind of spew it out like an acronym, but no documentation is powerful.
Let's talk about it. Break it down for me.
Yeah, there's no bank asking. Oftentimes persons get denied overwhelmingly in a bank because of debt ratio.
Debt ratio, break that down.
The amount of debt versus your income. So
give us an example.
Okay, so particularly banks want somebody to be at like a 36 to no more than 40% of all debt and mortgage payment, not being more than 40% of your gross monthly income.
Debt usage.
Debt usage. Thank you, more appropriately.
Okay.
However, with this product, we're ignoring, we're not even including, it's not even consideration, the whole notion of debt usage, because the focus of the program is on the property and the property's ability to debt service or cover the mortgage payment.
Okay.
So if the tenants, if you're collecting enough rent to cover that mortgage payment, you're good. But to go back to the no documentation part, that's where most persons stumble when it comes to the bank. Because the bank is not only just looking at their debt usage, but they get into personal misnomers about the borrower. They may get into personal conjecture, subjective stuff that's not objective about the property or the location.
You're talking about on traditional finance.
On traditional finance.
So why did you buy this, or why do you have this?
Right. Yeah. And they're going through the bank statements, and then they even may pull out trying to make some sort of assessment or assumption about the quality or the nature, the character even of the buyer. Well, because we're not opening that Pandora's box of your personal business in the form of these bank statements, the property serves as the primary principle in getting approved. Your credit, your money, and the property.
So you say your money, are you saying that's down payment?
Your down payment, and you also have to have a degree of reserves, which is savings in the bank to make sure, because during COVID, going back to COVID, many mortgage companies suffered because tenants stopped paying. So now we want to make sure that you have some reserves, that being 3 to 6 months of mortgage payment in the bank. However, here's a compensating factor. If we see that you have a 401k or some other savings vehicle or even equity in other properties, then that compensates, what they call a compensating factor. It offsets. So it's far more liberal, and it has more risk. So when persons may complain about the down payment, oh, it's 15 to 20%. We didn't ask you for anything. We didn't ask you for a thing. And that is really, as a lender, and I have to speak partially on it, I'm taking the banker's hat now. I've got to kind of side with the industry, because who's going to loan somebody some money? I don't know nothing about you. I just know you got good credit, because your credit can change tomorrow. So you know what I'm saying?
The problem, Renard, I see is people think these banks just giving out money. That's not the case.
Like, no, and they want it back.
Right. When I first started, I'm like, bank won't loan me no money.
Right.
I didn't know that. Honestly, they made the rules. I need to figure out how to fit into their rules.
Right. Or maybe circumvent it somewhat, which is what this product helps you do. But at the end of the day, all banks want their money back. Whether it be a brick and mortar bank or some stock or some hedge fund, everybody wants their money back. And this is the most liberal of all. And still sometimes I have persons complaining about the rate, or, well, I got to put so much down, because down payment is commensurate with credit score. So credit score is when you're saying unpack it, that's another principle. The higher your score, the less you put down and the more you can cash out if you do a refi.
Well, let's talk about your interest rate, because I don't even know what would be an interest rate on a DSCR loan.
Well, if you have 700 or better on a purchase today, I actually priced one, you can get a rate as low as 7.1. And FHA today is 6.1.
Okay. That's an investment, talking about investment property.
Right. But primary residence FHA is 6.1. This is investment at 7.1.
That's pretty good. Purchase
asks you for everything, your blood type and Rocky Road and all that. This asks you for none of that. And it's 7.1.
Okay.
And it's incumbent upon you to make sure that you're not to break the back of your tenants. I don't believe in gouging people, but to make sure that you are pricing the rent appropriately.
What do you mean?
Well, like my cousin, for example, good example. My uncle died years ago, and he had 30, 40 properties in Portsmouth, and everybody loved my uncle. Well, they gotta love him because he was charging people $200 and $300 for rent.
Oh wow!
$400. So my uncle passes. My cousin is the new king. He takes over everything, and they're ready to throw him out of the window. Cause he's like, wait a minute, we got to reassess this, man. Ain't nobody paying $400. My uncle had rehabbed the houses and put in jacuzzis. They're living like kings. And they were paying some people literally $800, $600 for rent. Well, my uncle from a different era.
I can see how that happens. Because a lot of my rents are low too, because you've been in the game so long.
Right. So this is what I'm saying about, you don't try to break the back. But my cousin said, look, come on now, we got to have a little adjustment here. And man, they were ready to torch him. They were having a fit. So that's the thing. You don't have to try to charge somebody $3,500 for rent, but that's why it's incumbent upon you. Let's go back to credit and using these products to keep your credit good, filing your taxes so that you can buy a house traditionally. But what we find in this industry, oftentimes people want it all, and you can't get it all. You're gonna have to fit somebody's box. Somebody's rule.
If you want their money.
If you want their money. Now, if you don't want to file your taxes, you want to be self-employed, we have products for that, a bank statement and profit and loss. But then again, there's 15% down, 20% down. And people are screaming about that. Well, how can I get it for a regular down payment? File your taxes. Then you can buy it traditionally. So, you're going to have to meet somebody's criteria. And I don't call it a penalty because if you're not paying your taxes, we haven't said it, but we're thinking you got that money somewhere. I don't know if you got it in a shoebox or, in the attic, you got that, American gangster getaway money under the doghouse.
It's got to be somewhere.
It's somewhere. So you should have the 20% down because you definitely ain't paid your taxes in 30 years.
Renard, you're a mess. So I want to make sure that my round-up family, people that want to go this route, this is lending. You don't need tax returns for this.
No.
DS.
No, sir. No W-2.
Oh, wow.
No pay stub.
So does the lease need to be in place already when they qualify for these type of loans?
If they're purchased, that's a good question. Like I have a guy writing a contract today, the property conveys their two tenants already.
But they're already existing.
They're already existing. So that's great if you're buying multifamily, duplex, fourplex, quad. If the tenant's already there, that should cover more than cover the rent. But if you're finding a new property, it is good to try to, if you're an investor like yourself, you have enough people banging on your door, it is good to have some persons in line because they're going to downgrade it, which means they're going to want another 5% down.
For the down payment.
Yeah.
Well, let's talk about it.
Yeah.
That's how it works.
Well, if you don't have a tenant, typically they are, instead of, let's say the best, it's only 15% down, that's 85% loan to value. So instead of 15%, if you don't have a tenant, they're going to say, well, we may want 20% now because you don't have a tenant. Therefore, it's good if you're a seasoned or somewhat seasoned investor that you have that lease in place. 1 month's rent, 1 month's deposit. But you can always call upon the local real estate company that keeps a bunch of persons active. There's no shortage of people looking for somewhere to stay. Yeah. No shortage. So you should be able to navigate with a little bit of effort having a tenant in place before you close.
So we have a proposed lease too.
Mm-hmm. Yeah.
Okay, right. So I want to make sure people understand if you fake that proposed lease, then that is considered fraud. You still need to have something that you're
1 month's rent, 1 month's deposit, then we feel it's real.
Got it. I want when people say, well, I'm gonna make a lease.
Nah, and let me tell you something. Mortgage fraud is real.
It's
real.
It's got teeth.
It has a lot of teeth.
I'm sure we can say some names that we both know.
Yeah, mortgage fraud is something right now happening. We've had several persons, unfortunately, happen to be women who have been cited for mortgage fraud.
It's real.
And it's funny you talk about it because people sign applications, like you say, hundreds, thousands of them all across America.
The signed application.
Giving false and misleading. And it says on the last page of the 1003 or what they call a URL, giving false and misleading. It says false and, not just false and misleading, can lead to a $10,000 fine and up to 10 years. It's either 5 or 10 years in prison.
That's on the thing.
Per infraction though. So if you're around here buying 2-3 houses at a time, that's 5 times 3, man. That's 15 years.
That's deep.
And people sign it. No different than people signing real estate contracts. Look, true story, my mama gonna kill me, right? But I'm gonna tell her anyway because she and I laugh about it. My mother, when she really wanted a house, years and years ago, she wanted to get back into the housing game. My mother just wanted to have a house. She's a Christian. She's a minister praying for a house. I said, Mom, we're gonna get you a house. We got to get the right house. And she just kept writing contracts on homes that she later changed her mind. And because I'm in the industry, people saying, look, man, we try not to sue your mama.
Oh, wow.
You need to, dog, you need to get your mama under control. Because it was only because of me that they knew me. Yeah. They're like, look, and I had to say, Mom, this is a binding document. So that's one thing I really want to end on, no matter what you sign. make sure that you read it before you sign it and that you understand the gravity. I think we're talking about what the gravitas. You need to understand the gravity of putting your signature on stuff.
No doubt.
Yeah.
My friend, if managing your rental properties feels like a second job, you're doing it the hard way. Base Lane, an integrated banking and bookkeeping software, just launched Base Lane Smart. And let me tell you, it's changing the game. This thing automates your rental finances. I'm talking about auto tag transactions. It looks at who you're paying and tags that transaction. It also has bulk upload and auto match receipts to transactions. You know, you've got all those receipts from Home Depot or Lowe's, you scan it and it'll pull out the pertinent information to match it for you. No more of going to the bank and depositing a check and having to wait 10 to 14 business days to get your check. Doesn't that drive you crazy? So I don't have time to sit around doing admin work all day, and neither do you. We're trying to build wealth here, not babysit spreadsheets. Base Lane Smart runs in the background so you can focus on finding your next deal, not tracking every dollar. You work too hard to let paperwork kill your profits. Level up with Base Lane Smart and never look back. You want to know how the smartest investors are saving hours every week? Click on my special link to try this out for free for 30 days. Trust me, this one's built for real estate investors just like us.
Well, I'm just thinking about people that perhaps if they want to get a hard money loan to do the deal and renovate it, and then place the tenant and possibly do this DSCR loan. Is that a thing?
Lots of people do. But however, a caveat or an exception to that is if you already have property, tap that property, do it no doc, cash out, refinance, and now you become your own bank.
You got the money.
You got your own money. I mean, we did a loan. I told him when we first met for coffee about a guy, we both know him. He took out $700,000-800,000 and then bought another building. Yeah, with a decent rate. And now he's about to tear that building down and build 4 $700,000 properties.
Yeah, that's deep.
That's deep. So this DSCR can do a lot if you know how to use it. And I think that's a big phenomenon for guys like you in the investor game, is becoming your own bank. Well, here's one way, but you can't be afraid to pull the trigger. You know, you want the money. We have to get out of going to hard money if we don't have to.
Okay.
Be your own bank. And that means it could be family members could come together and do an LLC. And maybe auntie got a couple of houses or uncle got a few. No matter who, but you can take that money, use it to fund the project, and then let that pay the project back.
Well, I think we talked before, Renard. I don't necessarily think I don't think we as a culture have a money problem. I think we can get access to the money. I just think that we have our strategy. Like, say we get people all the time. I know people come to me every day. I just need the money. That's the golden. I mean, I'm sure you hear that every day.
Yeah.
I just need the money. Really, that's all I need. And I'm like, I don't know. I just feel like we have more of a strategy issue than a money problem.
I think I agree with you that it's strategy. I think fear does play a big part of it. Because oftentimes, we had when the rates went really low, right? A couple of years ago.
That was crazy.
Right? A lot of people have 2.3 and 3.3. But guess what? I have a ton of people consistently, they want to get into the investor game. I'll tell them, well, take cash out of your house or another property, especially your primary residence. And then you can buy that investment property. And they will, no.
They're scared.
I got 2.3. I got 3.3. I said, I understand that. However, if taking the money out is going to improve your ability to make more money, you can't look at it from a consumer standpoint. You have to look at it as a businessman standpoint. You have to switch hats, change perspective. As long as you're acting and looking at it as a consumer, you're going to always be a consumer.
Well, where did we get this thing of to where it can only be one person on an application, Renard? Because I'm like, it's just this whole game is it's a people business.
Well, I know who has not fallen for that misnomer.
Who?
My Hispanic brothers and sisters.
Let's talk about
They'll
it.
put 5 people on a loan.
Talk about
And
it.
if you look at an application, there are 4 lines. And you're not limited to 4 people. 4 people can buy a home. And with more persons moving back home, more persons having the necessity of needing grandma to help raise the family, it's intelligent for for 4 people to buy a house. And guess what? Grandma, granddad, aunt, uncle, and then the parents. Okay, well now you're dividing a $2,000 mortgage by 4 people. Now you're talking about $600 effectively. 4 people living for $600. Much smarter. But you know what it is? As Americans, we into this, I want my space. I want my own thing.
Well, I think once again, I want to love on my people. We see what our counterparts are doing.
Well, my Hispanic brothers are doing the do. A lot of my
we don't deserve. I'm like, why do we feel like we need to have? I want my space. Where I'm like, who are you to say that you could afford a $4,000 a month?
You can't.
That's the problem. That's where I'm going. I'm like, why can't we?
Collective.
The Hispanic, they got it down. They're my tenants. I'm doing all the time. I'm like,
and you know something, a very unique thing that I've seen my Hispanic brothers and sisters do. Every year, one person out of that pod, or every so many years, will buy a house. So this year it's your turn. Next year it's my turn. But the other 3 still sign on that application. So now they're building wealth in property. They're buying the home owner occupied, because even though the other ones don't live there, they're considered non-occupant co-borrowers.
Oh, wow.
You see what I'm trying to say?
Oh, wow.
Right. So from that one pod, they may launch 4 more properties.
Y'all hearing that? You giving y'all some game.
Now that's that Jay-Z with $1 million for $9.99.
That's some game right there.
Yeah, they'll from that one sale, 4 more sales, 4 more pods will be birthed from that one.
That is so cool. Even as I live here, I'm like, I don't see how. I know what I did to get where I'm at here.
Right.
It took me a long time. And I'm like,
absolutely.
dude, if you work with other people, you get that so much faster.
Yes, there's strength in numbers. You know, you mentioned you're a Christian, a 3 or 4 cord, not easily broken. There is strength in community, and we have gotten away drastically. We used to be when we were more less affluent. Let me put it that way. We understood community.
There you go.
Yeah, but as we became affluent, this team of me, like the man said in the movie,
I don't like it, yeah.
Right? That became more prevailing school of thought, and we lost a lot. We lost Granny. We lost Big Mama because right, we used to live in the house with Granny and Big Mama.
I miss Big Mama.
Yeah, a lot. Yeah, we need her back.
I want to ask you, Renard, when you talk about down payment, do you think that is reserved? Do you think getting into this DSCR thing is reserved for the people that have the down payment?
To a degree, yes, because you have to have the down payment or a means of getting the down payment.
Talk about that.
However, once again, with the person that has a 2.3 interest rate and has equity, there are millions of dollars of equity that Americans gained and didn't have to lift a finger to produce. When the
2020,
right, when the values went crazy, right? Some people gained as much as $100,000 or more. That was free equity.
Depends on where you live.
Depends on where you live. Now that's like if somebody went in your bank account and just dropped $100,000 or $200,000 in the end, or even 50, you'd go crazy. Where does this money come from? And most people would be trying to find a way probably to spend it. But the economy gave you $200,000 or 100 or whatever, and you refuse to touch it. But we know that what goes up will go down. I admonished something that was really radical. People, this man done lost his mind. I told people to take every dime of it out and go sit it in another account. My payment will go up. But what interest could you draw if you put in the right type of account, even if it was IUL, what have you, not giving investment strategies. But if you put it in something that was some vehicle that was making money, you received $100,000 to $200,000 that you didn't have to earn.
Wow.
So you could use that money to buy properties, not a property, but properties. Or if you don't want to touch the first, you can go and get a HELOC, second mortgage,
about that.
Right? So a lot of persons have all this equity. You can go to the bank, get a second mortgage. You can use the money from a second because it's secured by property. That's the underwriting rule. It has to be secured by real property. Your current residence is secure. It is real property. That's securing that HELOC or that second mortgage. You can use that money for your down payment or down payments.
Got it.
So we have access to capital, but it goes back to the strategy that you mentioned and to what I feel strongly, the fear factor. And the fear factor is real.
You talking about people who are just nervous about borrowing money because HELOCs are mostly, I mean, you're a money guy. They're generally on your owner occupant, correct?
Yes.
Are people nervous about that?
I think they're nervous about how to use it, what to use it.
They don't want to lose their house.
Well, if they're buying an investment property, and the investment property is going to it's going to be able to cover itself. The tenants are going to cover the mortgage. In other words, we have this desire for wealth, this desire for upward mobility, this desire to transcend from one plane to another. But you don't want to. You got to do what it takes to get there. You can't just sit there and wish on it.
I know, Renard. All I'm saying is,
Yeah.
I'm going to tell everybody, I had a HELOC, a home equity line of credit in 2005.
Mm-hmm.
I spent it all on consumable goods. And I was looking in the mirror like, you just a dummy.
Well,
You owe this, now you owe this.
right.
And you got the same property and now your payment higher.
Payment is higher. Probably don't know what you did with that mess. Couldn't tell yourself what you did with
I'm
it.
saying strategy. I'm like,
Strategy.
yes, we want to get the money, but we got to have the strategy too.
And you have to have self-discipline. That's why somebody, like you're married, man.
That gives some discipline.
Right. Somebody in the house has to be the financial disciplinarian. So that we can go into some other strategies. Like I did this thing I'd like to do with you one day. It's called it's about before you marry. And I look at it, I look at two persons as a corporation. Right.
This is business.
Corporation A, Corporation B. And typically before two corporations merge, they look at each other's books. Let me see who's the CEO, who's the CFO. You may be the good CEO, but you may not be the best CFO, the chief financial officer. So somebody in that marriage has to be the CFO.
That's a good point.
And a lot of times men think we can wear all the hats, and typically we barely wear any of them. Right? Because one thing about women, they're going to make sure them bills are paid. Me, I'm even to this day sometimes, I ain't going to lie, my lights get cut off because I forget to pay it.
I'm bad with paying. I'm good with making, bad with paying. I'm like, the money's there. I just don't feel like
And look, Vepco did the worst thing because now, they used to have to wait for them to come out and cut your stuff back on. If you pay your light, they click it back on in 15 minutes. Now I'm down there, it's sitting in the dark. I said, I need to pay my light bill. See, when I knew they would come out there later at night and my stuff may go bad,
you paid it.
I paid it. But now I know I can just call them.
That might be a man thing, though.
It is a man thing. Now, if there was a woman in the house, that would never be allowed to happen.
I'm coming home to a dark home many a day.
Yeah.
Many a day.
I done sat in the dark home. Just sitting on the phone. Click.
No water, yeah.
Yeah. See, so that's what I'm saying. In this whole transition, who's going to be the financial strategist? Who is going to be the financial disciplinarian? And that's often what we're missing. But for God's sake, two spendthrifty people cannot get married.
That's challenging.
That's a recipe for disaster.
Yeah, I'm the saver and my wife's the spender. So
right. Whoever. It's not a sexist thing, but somebody has to be, there has to be yin and yang. There has to be balance. And oftentimes that's what we're missing. And I do have this little theory, and I call it the spirit of depravity. I do think, but I would hope by now in this season of our sojourn in America, but a lot of us still suffer from the spirit of depravity, in other words, in the Afro-American community, not having this and not having that. We're still often first generation college graduates, first generation professionals. And we have this thing, I'm going to get mine. I'm going to get mine. I'm going to get the car with the numbers on the back, with the alphabets on the back. I'm going to get this. I'm going to get that. All consumptuous items that do not gain any type of, they're depreciating items.
Talking my language.
Yeah. Bro. So we are still very ingrained in that mentality. I'm going to get mine. I'm going to get mine. However, go back 3 or 4 generations, go back to even slavery, that because we were deprived, that was the goal of our great grandfathers. That was a goal that they were going, and many of them had land and left land. But here we now live in this society of plenty. I don't care what people say. America is the greatest country in the world. If it were not true, how is it that I've had clients who have walked away from properties their grandparents or grandmother left them because I don't want to fix that mess? I've had people walk away from properties to go live in an apartment. I told this girl, I said, you got to be crazy.
What?
I don't want to be bothered with that mess. That mess. Oh, if that's not the case, why do we have millions? There's a lot of things we could talk about. Why is it that we have millions, billions, not millions, strike that, billions of dollars worth of property on the city tax rolls coming up for tax auction?
I see that.
How is that possible that the city, these local cities have your grandmother, grandfather's property waiting for me or you, an investor like us, to come out into an auction and bid on it? Because we don't understand value. We don't understand equity. We don't understand legacy.
Got it.
I don't care if you moved out of town, that you now live in, I'm not coming back to that hick town, but you mean you got enough money that you can leave $200,000?
Wow, that's deep.
You know what I'm saying? That's what you're telling me. So there's a lot of money that's lost in the Black community because of lack of understanding and not appreciating it's not only the value of the property, it's also the intrinsic value. The fact that somebody worked at the shipyard, somebody was a cafeteria worker.
Somebody's life.
Went
into that, yeah.
To leave something, and we're frivolous about it, and a lot of times our kids are,
it's our fault.
Yeah, and it's our fault.
I gotta do better than that. All right, I got to keep you on this DSCR.
Yeah, man, because but see, that's all a part of it. That's
it's
a
up
lot.
Here. It all starts.
Yeah,
here.
that's all these things lead to why we're not in the game. As you have to deal with the whole patient. You have to deal with the whole man. You can't be a doctor and just say, well, I'm only concerned with your foot. Yeah, but the foot and the ankle and the knee and the bones thing, they all go together. So you have to analyze the patient. And typically it starts here and then it works itself down.
That's deep, man.
We got to deal with the head.
Well, I'm thinking about some people as we get older don't really like debt. And this thing here is almost like, there is really no excuse. If you saved your money. You got a down payment. All it wants is credit. Your credit should be good. I'm presuming that your credit is going to be okay. It's no reason as you age, your credit
and
should be good.
do you know how easy it is to just jump in? How easy it is to trick and manipulate your credit now? All these commercials, you can add your light bill, you can add a storage bill, credit, all that stuff you see on TV, TransUnion, Experian.
To report.
I mean, you can report regular household bills and it'll boost your credit score. Now, I don't need anybody calling me asking me how, because it's right on the local television. Experian boost, TransUnion boost, yeah.
Look at that.
Yeah, you can boost your score. You can put your rent and boost your score. You can put a storage bill, a light bill.
Okay.
And boost anything that you pay monthly that comes out of, I think, your bank or your debit card routinely, regularly. You can use that. So you can be at a 600 and be at a 750. 6 months. Yeah.
So let me ask you, I have to ask you, who is this not for? Who you say they should not go get a DSCR loan? Because this is still a loan.
It's very much a loan. Who should not get it? A person who has not decided they're going to effectively manage their property. Okay. A person that doesn't have what you keep using the word strategy.
Got it.
Somebody that's got to manage their property, even if you have to give a few dollars to a property manager, that person who is not going to be a good steward over the property, is not going to take care of the property.
So this isn't like a get the money and get the money and because I don't know where we get this passive. It's almost like a passive income has permeated our mindset as I've gotten older. I'm like, where do you think this exists?
Yeah.
Why do we think So people, this isn't a passive where you get the money and you don't have to do any action.
Oh no. Now you have to manage that property, and it goes back to like what you said. It's a strategy thing, and it also, when Jesus told them to throw the net on the other side, go deeper and throw the net on the other side, because you can buy property anywhere. You may need to look at a place. I love Texas. You may need to look at different places.
Okay.
Yeah, Georgia.
Especially my New Yorkers, they're in trouble.
Yeah.
I don't know. Yeah, one of my mentors is in Brooklyn, and he don't even buy in New York anymore. You got to leave.
You got to leave. We walked away from the brownstones. I remember one time me and my 4 friends had a chance to buy a brownstone when I first graduated.
For how much?
It's like $200. We talk about it all the time. I hang up on them when they bring it up because I get mad at them every time I think about it.
That's and everybody,
everybody was fighting about who gonna count the money. I'm like, come on, man. It was 4 of us. And then $50,000. I had my 50. And everybody else was fighting over this and fighting over that. Now, can you imagine? What is a brownstone? About $2 million?
Yeah. Wow.
Yeah. We had a chance to get a brownstone. Yeah, $200,000.
You can only talk about those nowadays.
Man, when they call me and they try to reminisce, I get mad and hang up on them. Like, there he go again. They're like, man, you ain't over that yet? I'm like, no, I ain't gonna never get over that.
Okay. DSCR, round up, homies. I wanted y'all to get this. This is the guy. We're going to put his information in the video description, show notes. You can contact him and he'll hook you up. And now I want to talk about what states can you do these in, Renard?
what do you call it? The South, Southeast. Let me say, we can start in Connecticut, New York, North Carolina, South Carolina, Texas, Virginia, Florida.
Mid-Atlantic.
Yeah, Mid-Atlantic. New York, New Jersey, Philadelphia.
Okay, cool. So
Cannot do California, cannot do Nevada.
you can't.
I cannot.
Okay,
but you can do them with the local lender out there.
I got it.
But I can, if you want me to bless your file and put my hands on them, any of those space. And those are places, once again, we should be reaching outside of our box. Ask your aunt, ask your uncle, ask your cousin, man, what's going on in Georgia? What's going on here? What's going on there? You know, a lot of times there's stuff popping in other places. Or if you can't do a DSCR, what states, I know Atlanta does tiny homes. Now, I'm not talking about me now. I'm just giving a plug. We should be thinking about that. We don't do them around here in Virginia yet, but man, you
Not
can make
yet.
Not yet. I'm waiting on it now. Yeah.
They got to come. It's inevitable.
Yeah, it's inevitable.
People can't afford this stuff.
Right. But I don't know, we got a powerful real estate board, but that's another story another time. They're a powerful lobbying group. But in other places like Atlanta, I know tiny homes is popping.
Yeah.
We should look at that. You can get a tiny home for what, 10 grand?
10, 20,000.
Yeah, you get a HELOC and go get $50,000. I mean,
Wow.
you can have your investment portfolio
Right there.
there.
Well, I'm just thinking about all my people that they don't want to raise private money, but they're not necessarily bankable with traditional. This could be an option for that person.
This is the option.
This is the option.
This is the option. I mean, and I really want to make a cry to younger people, these young brothers with this and sisters with this NIL money, these athletes, throwing up. Hey, whew, I mean, these guys could be gobbling up. Once again, what did we say? No tax returns, no verified, right? Income.
Wow.
Look at that. Instead of putting $200,000 or $1 million around your neck in a chain, how many properties could you buy?
Wow.
These young guys get some of these guys have multi-million. They're making more than pros. I want to talk to that group of persons. I want to talk to those young rappers. I want to talk to the TikTok influencers, people on TikTok making hundreds of $1,000s a year.
What you gonna do with it?
What you gonna do with it?
Yeah, I think, you know what's weird, man? My mentor told me earning is offense, but the managing is the defense we never get taught.
It is the defense. And I think a guy that you and I both are familiar with, Mr. Pendleton, he does excellent tax strategies. I'm not the tax person, he and persons like him, but it's too much money being, once again, mismanaged, poured down the drain. These guys shoot videos. Some of these young rappers shoot videos in $1 million properties. They don't own it. They just want you to think they do. Mm-hmm. But they could own it with this product.
Got it. Okay. And you can this is long-term. So the strategy.
It's 30-year fixed.
Oh, it is 30.
It's fixed rate mortgage. It's not adjustable. It's not a balloon. It's not going to go up. It's not going to go down. So there's no risk of it ballooning on you.
Sweet. So the strategy for a flipper, I mean, because if you own a DSCR, if it needs repairs, does that qualify?
No, but has to pass an appraisal.
Okay, so the strategy would be hard money. Move into. I'm talking about for people that can't qualify traditionally.
Yeah, get the hard money.
Hard money to acquire it.
Right, and rehab.
Acquire it, rehab it.
And then they can come to me after 6 months and take that cash out based on the new value. Not the purchase price, but we allow you to take the cash out based on the new value. You bought it at 100, you put in 100, now it's worth 400. You can borrow off of the new $400,000 value up to 75%. So you get your investment back plus some of your rehab money, probably all of it.
So once you're in it with the hard money loan, you could use the equity for the down payment, correct?
Yeah, the equity.
You're already in it.
Yes.
So you don't necessarily would need a down payment.
No, there would be a refi.
So the refi just needs to have as much equity in it.
Yes, absolutely. Right. So you can get 75% of that value of the new value. So you get to pull your money back out, your down payment and your rehab money.
So you may not even have to come out of your pocket with a down payment.
No.
If your hard money is, if you got a hard money lender that's going to work with you on that.
Absolutely.
And a lot of times they will.
Absolutely. A lot of times they will. And this is what the fix flipper guys need to stop doing. Stop fix and flipping because I think they probably don't pay it, but the government will come knock on the door one day. These guys forget about capital gain.
Oh yeah, I don't, but yeah, you're right.
Yeah, that's a 1099 that gets issued somewhere.
Every house.
Right? So you flip 5, 6 houses and then 10 years from now, the IRS comes knock and say, hey, you remember you made 100 on this one? And yeah, man, we need that plus penalties.
Yeah.
So instead of fix, flip, fix, keep.
Fix, keep, and hold.
And you can take the no doc and take 75% because what? When you rehab a property, you lose typically 10% anyway in fees between the listing agent.
On the sale.
right,
Cost
on the
of sale.
sale.
Cost of sale.
Cost of sale. So this way you retain it, and you retain the property, and the property goes up in value, and you provided the service of affordable, if you're reasonable, home ownership, because you could, 2 years you have to retain it, then you can sell it and avoid the capital gain,
Yeah,
right?
2 years, yeah.
Right. So if you then let somebody come in, here's a real plug. Let's say they do a rent with option to buy. They come in and give you 10% down or 20,000, whatever that. Now you've got 20 grand in security. You draw the contract, and then you wait 2 years, and then you sell them the house. So you've got the end strategy already in the house. You've got the exit strategy, and that's a real $1 million.
That's a good one. Rent to own works. Yeah, that's you right.
Rent to own.
Yeah. I don't want to give to that one.
We'll do that.
That's a whole nother.
Right, but here's a no doc and a rent to own. It's so many ways.
That's sharp.
That's
sharp.
Yeah.
Okay, so look, this is another. I brought Renard on here because he's in the traditional money world. Is this classified as traditional money?
It's becoming. It's very prevalent. I'll put it that way. Zillions of people utilize it, but we don't utilize it enough. I'll put it that way. It is a very prevalent product by the number of lenders that are in it. But we're not. And when I say use it, I don't mean just buying a house. I mean exploiting it. We need to exploit this product. Church groups need to form. Community groups need to get together. Fraternities, sororities, building investment groups. The possibilities are endless.
You got it.
Yeah, the young cats, and even if they don't have a credit score, their mama has a credit score, their daddy, their aunt, somebody. So you can do an LLC, and with the LLC, you open a bank account with it. And so now the LLC, you the money man, you the engine, but grandmama or mama or daddy, they're the credit.
Wow.
And so then you could buy as many properties as you want.
That is so cool, Renard. I'm so happy you're talking about this.
I appreciate it, man.
We're in this whole box. And other lenders have told me this. Our community is the only one with one person, one application. It makes no sense to me. I'm like, where do we even get it from? We need to be building a solid foundation, collective financing.
Yes.
That's the only way I was able to make it.
Because we don't understand. With fear, Jesus said the fearful will have their place in the lake of fire. And I was thinking about that scripture the other day, and I don't just believe it's the hell's fire. It is the fire right here. It is a fire of ignorance, of disbelief that comes back to haunt us because we didn't pull the trigger when we had the opportunity.
Wow.
You got $1.2 million NIL, and you blew that hanging out with your homies, and then now you got to go work on somebody's job.
Oh, Lord.
If you don't make it in the pro, you have to go get a job, and you could have had how many properties, not to throw him out there. I'm gonna applaud brother, Mike Epps, who's rebuilding Cleveland. He and his wife are buying up Cleveland.
I saw that.
Rehabbing. If anybody knows Mike, tell him call me, because I can do a no doc and get that cash out for it, and he can buy more. So tell Mike to give a brother a holler, because that's a powerful use. It's what you just alluded to. He bought the properties, right? They need money. He might have had hard money, whatever. But now he could come back, call me, and we could suck the cash back out.
All right. His information is below, guys. Don't if you're going to do private money, hard money, this DSCR thing, there are many, many ways to get a property financed. It's up to you to take action. And I know it can be scary. Your first one, tell them, Renard, is your first one going to be scary?
Depends on your appetite. But somebody that's hungry
and who
to
you
do
with
it.
too? Who
right.
you with? If you roll with somebody roll with the right person, be like, man, I'm not scared of nothing.
Well, I'm gonna cover you, and I'm not gonna let you.
You're gonna write it all.
I'm gonna ride all the way with.
He can come in. But come on,
yeah,
man.
Come on.
You come on in. You good? We're getting ready to wrap this up, and I know TT wants to say, come in, TT. You can say hello.
Hey, man. Nice to meet you.
This is Mr. Renard. This is Preston.
Hey, Preston. I love that head of hair, man.
Isn't this something?
I'm gonna get a spot for my ball spot back there. Let me get a little bit.
This dude's hair. The ladies love this guy.
Yeah, it's beautiful head of hair, handsome fella.
So I need y'all to do me a favor. Please share this information. You have to get this out to our community.
Yeah.
I'm sick everywhere I go. I'm sick and tired. I've been to Africa, Paris, London. We at the bottom. Like we just have to take action.
Action. Okay. Yes, that's the word.
You gotta take some action.
A lot of action.
And you might screw it up. I'm not saying that this is gonna work for you.
Right.
But at least I always tell my kids, I don't care if you mess up. I don't care.
right.
At least you tried.
Well, you get with reputable persons like myself, like you, somebody that's going to hold your hand.
Mitigate the risk.
Right. And mitigate. That's right. Mitigate the risk.
That's it.
And somebody that's going to hold. I'm not just going to get a loan and drop you. I'm going to look at it. I'm going to make sure it's good. We're going to work with competent people, agents and the like, to make sure that it's not good for them, but it's good for you, that it's good for everybody.
Sweet.
Yeah.
Sweet.
That's what's important.
All right, y'all, subscribe, like, and we'll see you on the next video. Peace.